Good evening, everybody. Welcome to the Saturday morning edition of the Expected Returns Review. This is for the October newsletter, and hopefully I'll get that all out in the next couple of days. My name is Mark Robertson. I'm joined here by Sean Mace of
Hello, everybody.
Eastern Pennsylvania, not too far from Hershey, Pennsylvania, for those of you who can put a place on that. And welcome, Sean.
Thank you. It's coincidentally, it just happens to be just as sweet in Hershey, Pennsylvania as it was on a Saturday morning. So this works out great.
There you go. Well, what this session is intended to be is to just basically take the old newsletter, which we're attempting to rekindle, revive, and renovate back into existence. And, it's always been kind of a snapshot. I question the value of it, but, history is always a good thing to be able to look back on and learn from. So we're going to try and do that. For those of you out there that keep telling me that it can't be a review, Revue, and that I'm misspelling it, you're wrong. And a review involves dancing. In the case, that's what the dancing rhino is for. Think of that as a chorus line of rhinos, and we'll do a little dancing with the rhinos. But we are going to spend some time on the features. The Fedex as the stock feature, ARK Invest as one of them, the exchange traded funds that's involved, capturing lightning in a bottle as another theme. A reminder about our Successful Investing 4, which is affectionately, or I guess unaffectionately, known as the COVID Cancellation Conference number 4, coming up in mid-November. And again, the spirit of what we want to try to do here over the next few minutes is keep it brief, keep it succinct, but it takes me back to Saturday morning, many years ago, over 30 years ago, bordering on 40 years ago in some cases, where I would basically walk a couple miles to a coffee shop, one of the early Starbucks, by the way. Between that and the St. Louis Bread Company, would sit and have a cup of coffee and grab that week's Barron's as I was figuring out the investment club stuff, and literally put my feet up with a cup of coffee and the current morning's Barron's. And that's why the cover is on there and the cup of coffee. And that's kind of the spirit that we want to walk through this session with. Do appreciate those of you that were coming on Saturday morning, and I did have to defer it until Tuesday, so thank you for your consideration and patience. I had a family obligation that I had to take care of on Saturday morning. So with that, let's go ahead and get underway and step through expected returns for October 2021. Here's a reminder that no investment recommendation is intended. You're going to see a whole bunch of manifests of current stocks and some case studies, analysis of suggestions that were made in the past, and stocks in real time. So please, everything that we do here is for educational purposes. It's for demonstration. What we're really trying to do is take over 8 decades of lessons from the modern investment club movement and apply and deploy them with stocks and portfolios. So that's what we're doing. Everything that you hear here is an opinion. Sean or I may actually hold companies in our portfolios, and we'll try to remember to disclose that. But please, please, please do your own homework and make your own decisions based on your own studies of the companies. As a reminder, we do have a session called the Roundtable. It's a monthly webcast, last Tuesday of every month. Many of the names on the list are familiar. Welcome back. There are a few new names. That session every month on the last Tuesday of the month, 8:30 Eastern Time, is a friendly webcast where we share 4 or 5 ideas and step through the analysis of and study of them as to why they capture our attention. If you have any questions or if you'd like copies of these slides, they are going to be posted on the Manifest Investing Forum, but please send me an email, markr@manifestinvesting.com. Here's basically the agenda for tonight's session. Again, the hunt for Red October is just simply a reference to the small companies that we try to hunt down for the list that we feature every Halloween, and we'll go into that. Fedex company as a stock to study. Solomon Select. It was selected by Hugh McManus with no preparation and fanfare. It's just simply a high quality stock trading near its 52-week low, which captures his attention. And almost as a write-in candidate on Thursday night, was very nearly selected as a virtual write-in candidate for the stocks that were presented at the September roundtable just a few days ago. Featured fund, we're going to talk about Cathie Wood and ARC Innovation and their success, because they have been really under some fire here over the last several months. But when you put the last 8 years into perspective, including the last 6 months, but the last 8 years, hopefully your perspective will change a bit. Stock screen, a bunch of oversold stuff. We want to talk about that, as September was a train wreck for many companies, and stock prices got crushed in many cases. So where are some of the opportunities? We'll bring you up to date on the tin cup demonstration portfolio. We're happy to see September in the rearview mirror. And we'll do a little bit of a repeat from this afternoon for those of you that were there, and just talk a little bit about the efficacy of stock studies. Let's go ahead and start with the tin cup. And Sean, go ahead and interrupt at any point. Just wedge your way in here. If a question comes from the audience, or if you have an observation, or if I miss a key point, please feel free to do that. We appreciate that.
Absolutely.
Would you care to lead us in a tune of "I Don't Like Mondays"? Or we should probably forbid singing here, but we don't like Septembers when they behave like the September we just had. Tin cup sunk back below 4 million again. That's the bad news. The good news is we'll get to celebrate going through the $4 million milestone at least one more time. That usually comes with ice cream and cake when it happens. And you can see we've already had ice cream and cake a couple of times. But we've had quite a run. I mean, that run over the last year and a half is pretty massive on the right there. So it's hard to get too upset about this glitch downward. That's a pretty good sized glitch, by the way. That's almost a 5% drop.
Yeah, but you can be, that's 5%. Look what happened in March of 2020, and you still recover. It just goes to show you, buy the dip or be patient.
Oh, yeah. And that goes for back here even more so. One of the worst time periods in stock market history. And if you just simply kept accumulating better companies at better prices, you were all set. And so, yeah, I get a little bit upset and a little bit anxious anytime we get the bends here, as you can see from that inset chart. Well, we're still at 15.4%, beating the Wilshire 5000 by 5 percentage points, which is cool. Here's a look at the portfolio as it stands today, the 3.9 million in total assets. What this is ranked from highest return forecast to lowest. So the buying opportunities at the top, the selling opportunities are at the bottom of this chart. There is no need to sell. We'll talk about that in a second. But it's a fairly eclectic group of companies. No companies added this month. It's just a pretty eclectic group. Here's the way we look at the portfolio. For those of you wondering, where does Tin Cup come from? You can either choose the Kevin Costner, Rene Rousseau movie Tin Cup as the inspiration for it, or that top quote. They both work for me. Tin Cup and Warren Buffett basically covers it all right there. For those of you that are unfamiliar with the term efficient markets basically suggest that all stock prices are basically correct, and all the information known or available on them is widely known and widely distributed, and that there are not pricing inefficiencies or opportunities in the market. We don't believe that. And neither does Warren Buffett, neither did Charlie Munger, and neither did Phil Fisher, three people that we respect greatly. So that's where the name Tin Cup actually comes from. A bit of trivia there. The report card for the portfolio, the projected annual return is 13.1%. We love it when we're up above the low end of the sweet spot, which is 5 percentage points above the median return forecast of 7.8. So that checks. Decent quality, we're in that upper percentile. Decent growth, we'd like to see the growth of the portfolio in the 12, plus or minus 12% range. So the key parameters all check fairly well. P/E ratio is not too ambitious. Dividend yield is just kind of an extra 1%, which is basically kind of matching the market at this point. And really nice A quality financial strength and pretty good up, straight, and parallel when it comes to the graphs. Now, the 12% in growth is also buttressed by the fact that we've got a pretty good distribution over here. Basically, half the companies are faster growing, smaller companies, about a third of them in the medium-sized workhorses, and about a quarter of the portfolio in blue chips. Then you can see that the sector diversification is distributed pretty well in, 1, 2, 3, 4, 7 different sectors. Nothing really dominating. Many portfolios will have a little more technology than that, but nothing to be concerned about. Pretty good distribution overall. Any comments or questions at this point from the audience, Sean?
No, everyone's just enamored listening to you, Mark.
Okay. Either that or they're watching baseball. All right. Here's the worksheet of what we did with this month's decision for the portfolio. This is the worksheet that you get for any dashboard at Manifest Investing. When you click and pull in the worksheet, keep in mind, and this is an area where it can get confusing. I use these things all the time, and I still get confused from time to time. You're on a dashboard and you go into the worksheet. It's basically pulling up the last version that you worked on. And it'll one of the options you have at that point is to reset. And again, if you're getting ready to start a work session, you basically reset it so that any changes that were made to that last one are overwritten, and you bring in the full current portfolio. So again, just be careful with that. I've dealt with a number of letters of correspondence where people were confused about, where did my company go? Why is the shares wrong on this one? And the reason is it's retaining that last what if worksheet that you had for the portfolio. In this case, taking a look at the situation, the top two returns, we do like to avoid accumulating anytime they're above the sweet spot to the high side. Now, those are not exorbitantly high, definitely not nosebleed. So we might consider investing in either Addis or Jazz, but we do note that they're already fairly full positions at almost 7% of total assets. So we just kind of skip over those. Same is kind of true with British American Tobacco. Still like it. I don't necessarily like the product, but that's an argument for another day. The return is a little bit north of the sweet spot at 18, but we do see that the growth is a little bit low. So we, at 4.5% probably have enough. That takes us down to the company at the top end of the sweet spot range, and that's Mdc Holdings. Only thing against Mdc Holdings and accumulating another 125 shares of Mdc with the cash is that it is still one of the discretionary companies, and that is a pretty good slice of the pie. You generally, in a tie-breaking situation, maybe want to avoid more discretionary, but don't obsess over that. Don't obsess over that. Just kind of chill. It really becomes more of a consideration if you were selling an existing holding and replacing it with something new from outside the portfolio. The percentage of cash is actually fairly low in this portfolio, so that 125 shares doesn't make a big difference. Okay. Here's a quick look at some of the other, we refer to this as the parade of opinions on companies. One of the points that I wanted to make is we did wrestle with the notion of possibly selling or partially selling a little bit of EPAM last month when the stock price was at 633. The upside downside ratio was getting down there to the point where it was getting close. I mean, it's still above money market rates. This is a extremely high quality company, about as up, straight, and parallel as you can get, but there is some stuff going on here, some noise. So we hung on to it, and of course our reward for that is a 10% decline over the next month. And now we don't have that same situation because the return forecast is now 5. These are still kind of ugly over here, but the upside downside ratio is actually back in the hold range. So the sell temptation just kind of goes away. This portfolio does not need to sell anything with the portfolio par above the market median. And basically what you're looking at here is just kind of a distribution of other types of opinions, the relative strength index. Interestingly enough, I just left these in here just to kind of show you guys 5 of the companies in Tin Cup are actually in the Manifest 40 most widely held companies, and a whole bunch of them have been roundtable selections, as denoted by the RTs. What is there? 12 of them there were actually covered in roundtable, those monthly webcasts. So from top to bottom, pretty decent situation. Question, Sean?
Oh, I was just gonna say regarding EPAM, it's always nice when a situation resolves itself.
Yeah, but
Problems fix themselves.
Resolving it that way isn't ideal. But oh well. It's it's the type of situation. You look back over the years, and we've talked about this a number of times. David Gardner's investments in companies like, well, Amazon for one, but the one that always gets me is Netflix. I mean, you had to basically bite down hard, and speaking in your terms, Sean, diamond hands, big time diamond hands for hanging on to Netflix. Just hanging on to it and hanging on for dear life and being incredibly rewarded for doing so.
Buy the dip.
Buy the dips. All right, so here's another look at the portfolio. Our decisions this month really don't have that much impact. We certainly don't want to mess it up. We certainly haven't done that. Put a little bit of a boost up on the projected annual return of the portfolio. So again, not a whole lot of action or activity this month. One of the things that I did put together is for those of us, and I said us, that might be out there shopping for bluer chip core holdings that might be attractive. I put together a list of A++, that's according to Value Line, financial strength companies, and ranked them by their manifest rank. Keep in mind that the manifest ranking is a combination of these two things. So the manifest rank is just basically a scored index, if you want to think of it that way, and ranked from the top percentile down. So Facebook, with all the challenges that they're facing right now, I probably would not be real eager to go into that one, but some of the companies towards the top of this list actually do attract our attention. Here's that write-in candidate again showing up from the round table. Lockheed was presented by Kim. Merck came up with a COVID solution fairly recently. So these are 3 companies that have fairly decent projected return on values, very good quality ratings. This number here simply means that it's trading near a 52-week low. There's some interesting companies on here that are venerable companies that are might be worth a little bit closer attention. Again, not the sexy, exciting return forecast that you see here, but pretty solid and pretty good core components of portfolios. All right, so let's go ahead and keep pressing on. Here's one kind of a new technique that I'm kind of falling in love with. And what it has to do with is, okay, we're looking at EPAM Systems. It's a core holding in Tin Cup. It's got very formidable financial strength, good earning stability. It's up straight and parallel, very high quality rating. So again, we would treat that as a core holding. We would not want to consider selling it as an individual stock from the portfolio on an individual case study basis until that projected annual return approached money market rates or less. So you're basically looking for this 4.7 to be down closer to 0. And so that's the situation with it. But you can also ask the question, well, what would I replace it with? And what I've been having a little bit of fun with is I'm taking the characteristics of this company and I'm basically asking the question, is there a stock out there that would improve every one of those key aspects? So putting into a stock screen the projected return of 4.7, the 95 quality, the financial strength of 76. I actually scaled back the growth to 20 because you're not going to find too many above that, trying to get a few more candidates, and the EPS of 87, and here's the result. You basically get a blank. So that you don't actually find a single company which would improve all 5 of those things. So again, if you were really desperate to sell from the portfolio, you might crank the growth forecast down. If you basically back off on a couple of these, you start to get to the Googles and maybe a Boston Beer, but they don't come very rapidly. So it's just a good situation. And you probably would want to maybe crank this number up a little bit too, just to enhance the change that you're making and maybe offset some of the tax effects. So this is probably going to become one of my favorite things to do with my personal portfolio when I'm thinking about replacing a stock. Ask that question, well, what out there basically improves it across the board in the portfolio? And in this case, there isn't one. So I think that's kind of cool. Anybody that thinks that's really stupid, please gently let me know in the comments, or if you think that's kind of an interesting concept, Mark, let's scratch our heads over that one. All right. Any other questions at this point, Sean?
Dennis Roman was pointing out that never mind improving, you couldn't find anything that was equal to it. So
yeah,
can't find its equal.
Absolutely. Yeah, because once I found one that's equal or close, then you would have to think, would it be worth the incremental change?
Yeah.
Oh, yeah. Thanks, Dennis. All right. Now you've heard me talk about this one, Sean. This is that going back to that really ugly time frame back in March 2020. And you and I have had a few discussions about this and some of our texting and whatever. But back in that time frame, first of all, the suddenness, the rapidity, you didn't have time to act on any of this stuff. In fact, I was shuffling around cash, getting cash in position to actually do some of this opportunistic investing back in this time frame, and the stock prices were just taking off, and it was really quite frustrating and annoying at the time. I mean, I had a couple of them that. The one that I remember, Chef's Warehouse, I was almost ready to pull the trigger, and I went up and made myself lunch, came back downstairs, and I am not making this up. It had moved 20%. It was almost GameStop-like, Sean. It had
love it.
20% while I made a hot dog, and blew my opportunity out of the way. So what I want to point out here is back in this time frame on this date, again, March 26, 2020, all of the companies on here had relative strength indices. These are the current values here, but on this date, they were all close to 10, between 10 and 20. Okay, so some of the opportunities were just amazingly oversold. So way oversold at the time. And so what you're looking at here is how have they done since that point in time. Those are annualized numbers. So this group of stocks, I actually did, after I finished my hot dog, I bought some Wolverine Worldwide that day. And I shared it, I believe, in the Decisions Forum here. And that doubled for me in about 9 months, from that $14 price up to almost 30. So this collection of stocks went up 76% annualized since then. So the point is, sometimes when the rhinos get stampeding and they basically get out of control, they create some oversized opportunities to the downside. And that was certainly true during that moment in time. And trust me, we were all gritting our teeth saying, how much more pain can we have with the decline in prices? But the opportunities were actually pretty significant.
So I'm actually looking at the dates here, Mark. This is actually, it must be a coincidence, but this is also the same time that we were looking at Costco and Switch. That also happened, I think it was on March 23rd. That's when their lowest was.
Is that when I went into Costco?
Yeah, yep, you hit the, and for me as well with Switch.
Okay, well we'll have to do some comparisons later. I need some time for that one to work out better in my favor before we pull that one out. And actually,
March 8th.
yeah.
March 8th is when we looked at that Costco and
All
Switch.
right. So lightning in a bottle, why am I bringing it up now? Because the rhinos are doing it again. I mean, between July, August, and September, particularly September, they're beating up some companies pretty bad. Yes, that's a scene from Jumanji, as the kind of reminds me of the Merrill Lynch bull running through the jewelry store in the old commercials. But yeah, the
I
rhinos.
was about to say, you're showing your age there, Mark.
Yeah, well, many of the people in the audience have similar experience bases. So, so really, what we're looking at here is some of the lowest relative strength index. So these are potentially oversold. Potentially oversold. So from top to bottom, there's some names that jump out, and especially this one. This one keeps popping up here tonight. So Fedex is one that we're going to take a closer look at and track going forward. The other one that kind of jumps off the chart at me, I'm really kind of drawn to double-digit projected return on values. We've featured it a number of times at the roundtable. They do have COVID stuff. They do have a number of other commercial products, solutions for healthcare. So Regeneron is another one that kind of jumps off the chart as it's been kind of beat up, but the projected return and the pars are decent, not setting the world on fire, but still pretty decent. So we're going to take a look at those going forward. Here's the look at Fedex, and Fedex has fairly steady company over the years, about an 8% top line growth rate now. So an 8% growth rate for the company, margins in that 6% range for projected net margins, and you can see that that is fairly consistent, credible with what's been going on. You can see the impact of the pandemic and COVID here probably, and they've had a little bit more here fairly recently. The PE over time, you could make a case for anywhere from 15 to 18. Value line seems to like 18, so I just left that at 18 for now. I'd probably drop that down if I'm doing a real study in consideration of the company just a little bit. But we're talking about a company with a decent projected return forecast, pretty decent projected return on value. All this stuff is adding up pretty well. There's the components of the projected return on value calculation. You can see that they're definitely trading near their 52-week low. The upside downside ratio has exploded. In fact, they're trading within 50 cents of their 52-week low, or at least they were. A very attractive interest rate. The banks trust these guys to repay their loans. Here's that relative strength index of 19, which has drawn our attention also. So it's showing up in a lot of different places. Kind of a worst case estimate, according to Value Line, would be that return. So there's a lot to like here. Pretty consistent earnings. Again, this is COVID, the COVID bump down and the resulting drop down in price. So again, a lot of consistency over the years with that bump for COVID. Here's the current situation and how it's dropped off. We'll talk about why in a minute, but the stock price has declined and jumped down to these levels here in the last few days. Here's that relative strength index below 30 and now actually getting below 20. It actually approached 10 a few days ago. Here's a longer term look at Fedex showing that it's not without its squiggles. It's not a straight line from A to B. We don't expect that, but we do get some excursions. So excursions are normal. We're not surprised by excursions. And here's another one, a little bit steeper excursion right here. But I'm not sure what kind of an animal. Maybe that is a rhino run amok there on the screen with my Madden stuff. But again, left to right, still a pretty good situation, especially that blue line. Here's the most recent summary from the Value Line analyst, Kevin Downing. And again, keep in mind that this is now a couple months old. So he actually nailed this because this is what actually materialized in their most recent report. They're just running into putting enough people to handle the packages. And they've had to move up some capital spending and all that kind of stuff. And it's an awfully good problem to have is too much business. And that's the situation that they're faced with. They've actually had to outsource, basically paying twice for some of this stuff to get it delivered. So, pretty talented management team at FedEx. They're probably going to figure that out, and they're making investments to accommodate some of the challenges that they're facing. Pretty good prospects worldwide, and again, he closes with pointing out that they were attractively valued at 273. Well, they're now under 220. And the general condition of the business has not changed. I don't think the problems that they're, no pun intended, they're not terminal. Probably temporary and manageable. Truly challenges, but not challenges that they can't overcome. So, pretty good summary here by Kevin, and definitely worth our attention. I'll probably rake this one over the coals a little bit more and consider buying some of my own, but please do your own homework on this one also. Like I say, when it landed near Hugh McManus's on the 52-week low, he loves buying an established, capable company, with a long-term consistent track record that is trading near its 52-week low. Well, this one has it in spades. Any questions or comments on that, Sean?
Nope, you are soothing the audience with your Barry White voice.
All right. Let's go ahead and wrap up with a couple other things here. We've got, here's the fund manifest for October, and we share this one from time to time. These are the most successful. We've got, I would say, approximately 700 funds in coverage, and they should be in full coverage at Manifest here fairly soon as we complete our refurbishment and our renovations. These are basically the companies that we like to look over, the funds that we like to look over their shoulders, because they've demonstrated that they know what they're doing. Most of the companies on here, we're talking about a 10-year track record, and the amount that they've beaten the Wilshire 5000 or the total stock market is over here, and that's what ranks these. So, from 16 percentile for ARC Innovation over a slightly shorter time frame from December 2014. A little bit different benchmark return as a result of that. But 16% is really something to beat the market by, down to 6. These are all good. These are all either individuals or teams of people who clearly have demonstrated they know what they're doing. The one common factor, and it's circled in red here, you guys already know the drill, is if this doesn't convince you in either your investment club portfolio or your own personal portfolios, especially if you have the normal amount of risk tolerance that an investment club person would have and a decent long-term time horizon, you want to have enough growth. Having enough growth and making the right decisions, better companies at better prices, is how you get to this. And we demonstrate with our model investment clubs across the nation. And it's just a very serious consideration and a very powerful reminder. You can tell from top to bottom looking at this list that they don't all have the same style. I mean, look at the wide range of quality rankings or ratings in that column there. So they are using different techniques and methods, but the one thing that they do seem to have in common with the universe of mutual funds out there is the high growth rates. It's fascinating to see the number of Fidelity funds on here. Go Boston tonight in the wild card game. Look at the Morgan Stanleys showing up. Look at the Motley Fools. But at the very top of the heap, and again, it's you can find it written everywhere. In fact, we pick on Kathy every week with our Groundhog update, because she is right now 140th out of 144 participants since February 2nd of this year. So she's having that particular exchange traded fund is having a tough year. But when you take a look at the performance over the last 7-ish years, and this includes that period of doldrums that we've seen over the last few months, that's a staggeringly good track record. So in terms of, again, the theme for October, and we're going to cover this in future weeks, during our bull sessions, as we look through the innovation portfolio, looking for companies that would be attractive and interesting for our best small companies. Again, it's just a natural place to look over the shoulders of somebody who has demonstrated they know what they're doing, and it can be a great thing. We'll probably spend some time with Bill Mann in this one here too. They think like we do at the Motley Fool, and Bill Mann has quite a good track record. It's a brief track record. My experience with Bill goes back before the public version of this fund, so I have a little more awareness, but they're doing just fine. So again, as an idea of a place for funds, and then if you want to extend beyond the small funds, there's the Motley Fool 100 also. Note the quality, and they tend to invest like we do. Any other comments or questions at this point, Sean?
Nope. The audience is Demi Moore in the pottery scene to your soothing Patrick Swayze style.
Well, all right. If I were actually from this list to invest in today, again, I would look for the higher projected return on values, the higher pars, and thanks to the market that we're in, it's probably more fairly valued than it's been in a while with the pullback. I would probably end up in one of two places. Last month's selection for the fund was Vanguard Technology, and that has probably even gotten more attractive over the last month. The other one, if I'm investing in a fund versus individual stocks, would probably be QQQ because of the higher returns and the relatively higher projected returns on value. Now, there's other candidates here that are just about as good, but I really do like using those as part of, if you're a fund investor, they're fairly attractive. Here's the situation with QQQ. It's actually taken quite a hit during September. The stock market was down 4.7% during September, and you can see that so was QQQ. The longer term look at QQQ, again, or triple Q, whatever you want to talk about, the excursions are normal. Stock prices fluctuate. However, whatever it takes to put that into context, this one isn't even that big compared to what we've seen in the past. So stock prices fluctuate, could be an interesting opportunity for accumulation. Accumulating what? Here's the companies. You guys all know the drill. From top to bottom, 73% of the assets in Invesco QQQ are household names. And that's a pretty good representative slice of the portfolio. These are all weighted averages down here, all weighted averages. So that's what we're basically looking at, the composition of QQQ. All right, let's close with our hunt for Red October. We covered a little bit of the stuff this afternoon. The reason that we love to do this is on your screen. One of the things that I hadn't really thought about or noticed, we've had a pretty good 7-year run in the stock market, but what I hadn't noticed until just tonight, again, the long-term average return in the market is 10%, but look at the number of times in the last 7 years that we came in under that. Look at how strong the Wilshire 5000 was in 2017. Look at how strong it's been this year. And of course, the thing that Ken and I are quite happy with and hopeful that it will continue this year is we have actually outperformed the Wilshire 5000 by a significant amount. This actually comes out to 19% over the last trailing 6 years with the companies we've featured every Halloween. Versus a market at about 10% on average over that time frame. So beating the Wilshire by 10 percentage points. And this race up here was narrowing during September. And in fact, as of the close of business tonight, this had actually bumped up to almost 46, and this had bumped down to about 33. So we continue to be hopeful that we're going to have our 7th consecutive year of good performance. Here's what we're doing during the bull sessions and some of our other sessions during the month of October. Basically scouring these for ideas and candidates for our small company list. This afternoon, Sean and I went over the Fortune 100 fastest growing companies. And we spent just a few minutes noticing that there is an FT, the British Financial Times, have their own list of companies. And again, we'll mine that for potential ideas to make the list. In other weeks recently, we've taken a look at some of the Y-chart screens, the screen at Better Investing for the small, predefined small company screen. And then we did go back to the place where it all started, the Forbes list of America's best small companies, and we'll be watching all of those sources.
I do want to add something here, Mark.
Yeah, go ahead.
So the Financial Times, what I do like about them is that even though most of the companies they are showing aren't not publicly traded, a lot of them are gearing up for IPOs. So what's nice about them is they actually can give us a nice little look into potential.
Oh, you cut out a little bit, Sean.
Yeah, sorry there. Yeah, right. Sorry, but a lot of the companies they have in there don't have public tickers yet. So, but a lot of them are gearing up for IPOing. So it gives us a nice little view into what companies could IPO, and just lets us prepare for that future. And Chideman O does have a question. What is the time frame for the par value, 3 years or 5 years?
Our time horizons are always 5 years. And the numbers are all, whenever we express a figure like that, they're always annualized. Okay.
So annualized for 5 years.
Mm-hmm. All right. So yeah, I think we could unearth some interesting opportunities. I agree with you, Sean. Many of those are private, but there are quite a few that are early stage and launchpad type opportunities, as we talked about this afternoon. So what we hope to do next week, Sean, if you're willing, and there may be some other people in the audience participating, so I want to continue that theme of searching the realm of social investing, the social networking with Reddit, Twitter, StockTwits. We've already got a couple of lists that we've put together, and just want to see what's out there for potential ideas. Probably throw the Microcap Club into that group too. They've got a bunch of presentations from the recent conference in Chicago, so we'll probably try to cover those as sources of ideas next Tuesday. And of course, for the balance of October, we're going to go back to our dear friends at the Motley Fool, Dave and Tom Gardner. Here's Kathy representing people who know what they're doing. Bill Mann qualifies for that too. So does Brown Small Company. This happens to be Chris Jenner, not the Jenner you're thinking, but Chris Jenner. He runs Rock Springs Capital, and he's renowned for innovative healthcare investing. So we'd like to check in on his ideas. And of course, the audience was bringing us a number of ideas. I have a good half dozen or so from just the last couple of days, the needles in the haystack. So we will continue marching down this path during October, and I can't wait to see where we end up with the 20 companies in the King of the Hill effort as we progress.
I do think it'll be something worthwhile. I hate to have you go back a few slides, back to the RSI when it's under 20, but a lot of this stuff, when it comes to these RSIs, end up becoming self-fulfilling prophecies when they reach these levels, that anybody's going to start investing in them. And once they realize that they're actually good companies to invest in, they stay invested in them. So I do like that self-fulfilling prophecy that comes with these low RSIs.
Yeah, and it's kind of a matter of, once all the rhinos jam through the door at the same time and they find themselves all standing out in the cold outside the barn, it's just a matter of time before the institutional investors flock back in. Especially if you're dealing with a company, you talk about FedEx, when your operating business model results look like, where'd it go? Look like that. There's a little variation to them, but pretty much up straight and parallel. So if you're dealing with an up straight and parallel company and the rhinos have overreacted, it's just a potential opportunity with merit.
Dennis Roman has a question. Any way to create virtual ETF on the 20 stocks you recommended at month end so we can buy the basket?
Oh, that's something that we probably should look into. Ken and I have talked about creating real money portfolios. And I really wish we'd have pulled the trigger this year, because one of our companies has gone up 23% in 2 weeks. Southern Missouri Bank Corp. It's actually at risk of getting away from us. Here's the list, by the way, and this is one of the last slides we'll leave you with. Here's the current 20 companies and some of the challengers and some of them that have fallen off the list. Dennis, that's a really good question. There were a couple places that you could do that in the past. Might spend a little bit of time thinking about putting together that basket to make it investable. So thanks for the nudge. I do intend to probably invest $1,000 into each one of these just to track it in a real money portfolio this year. All right. So there's some study candidates on the list. Some of those are not going to withstand audits and challenges, but that's what this is all about. A couple companies are a little bit lean on the growth side of things, the growth expectations. So we'll be scratching our heads and verifying and confirming that kind of stuff. All right. One last topic before we sign off. It's one of our favorite topics. This has to do with Mark Hulbert and the Wall Street Journal and Market Watch and some of the coverage that we have participated in over the years. And this is a busy chart, so let me boil it down for you. We covered this afternoon. What this basically says to me, and I hope it says it to you, is this is what it comes down to. From left to right, what you're looking at is a series of forecasts. Value Line, again, is a collection of stock studies, very much like a pile of stock selection guides. And all they do at Value Line is add them up and say, what is the collective forecast? So in other words, those red bars are what did we say was going to happen 4 years ago? And then what the green dots are shifted to show the difference so we can compare actual results versus forecast is what actually happened. And I find the graph kind of fascinating. I don't think I'm statistically being reckless to suggest that those do tend to kind of follow each other. There are the moments, obvious moments where it doesn't, but those are just those special moments in time when things don't make a lot of sense. And here is our fairly recent pandemic moment from not too long ago. And I don't know, Sean, I look at this and think that there's a pretty good correlation with
Love correlation.
drifting and excursions.
Correlation's good, causation's better.
You like mine
Cracking the market.
better than your McRib this afternoon?
Oh, the McRib was delicious.
All right. So again, here's the chart. Keeping track of it over time. It's been published in the Wall Street Journal a few times. And just as a quick example, back in September 2017, the value line that stands for median appreciation projection. That's what this is right here. VL map is what Hulbert calls it. Was approximately 8% back in that time frame. The actual annualized appreciation from that time frame to the September just ending 2 days ago ended up actually at 13. So again, we've got one of these little bit of an excursion here to the upside. And we have come out of the pandemic a little bit stronger than we might have even expected. But again, it's just fairly well correlated over time. And again, over the longer term perspective here, since the year 2000, the average actual 4-year trailing appreciation is 10.6%. That aligns pretty powerfully with long-term results. All right. So with that, here's a quick reminder that more information will be coming out on this any day now. But over the course of the 10th and 11th of November, we're going to basically make up for the cancellation of the Better Investing National Convention and share a couple of presentations on the 10th and then a couple of presentations on the 11th, including an evening session with a stock panel and some what are always entertaining and sometimes quite rewarding stock selections. The stuff that we picked a year and a half ago is just off the charts to the good side. The other ones are a work in progress. All right. Another reminder, you can go to YouTube, just search on Manifest Investing. What I've shown you here is just simply the first 3 COVID cancellation conferences from top to bottom, and you can actually retrieve and view any one of them by going to the YouTube Manifest Investing page. And if you have trouble finding that, send me a note. We post links in the Manifest forum. If you do go there and you'd like to be reminded or nudged anytime we add one of our sessions, and we do archive all of our bull sessions, all of our roundtables, all of these webcast conferences, and now these expected returns reviews. Anytime we post that there, we basically nudge you. So with that, any questions or comments, Sean?
Oh, we're looking good. The audience is Meg Ryan to your comforting and charming Tom Hanks self.
Very cool. We'll let them get on their way to watching the Yankees and Red Sox. It's not like we don't get enough opportunities during the year with them playing each other 19 times, and I think they showed up on my TV about 17 times. Not that I don't love the Yankees and Red Sox, and I'm certainly not shaming either one of them, but they're on again.
Chideman actually does have a question. Does the stock screen support RSI criteria?
The stock screen does not yet. You can probably do that with FinViz or some of the other alternatives. And soon, very soon, hopefully very soon, you will be able to screen on RSI at Manifest Investing.
We're getting there.
Getting there. We're very close. We had to rebuild the platform software, for those of you that are not familiar with our challenges and issues. Just had to bring it up to snuff. And now we are in position to make some changes and enhancements and that kind of stuff. So with that, I'm going to go ahead and say thanks, Sean, for helping out tonight, and we'll go ahead and sign off. Again, this will be posted in the YouTube, and the slides and a link to the YouTube will be in the Manifest forum. So with that, better investing and good hunting out there, everybody. Thanks again, Sean.
Thank you. Take care, guys, everybody.